I'm super excited to be at Vault Summit. I think it combines three of my favorite things. First of all, working with great partner like Party Action People and Morpho. Being in Cannes, although beware of the seagulls, they're feral. And then amazing panelists here that we have. So I'm very excited to host this awesome panel on making credit yield composable on-chain. I'd love to do like a little bit of a round of intro. I'll start with Simon. I work at Gauntlet and partnerships, starting with Thibault, kind of like a little bit about what you do and what M11, CAP, and Gauntlet does.
All right. Well, thanks a lot for inviting me, Simon. So I'm Thibault, working at Maven 11. I'm mainly focused on the credit side of the business, so we're known to be a VC fund for like the past 10 years, but as we went through the space, we expanded the business and went for more credit opportunities. So I'm heading the DeFi credit space and everything we do with the M11 credit entity, risk underwriting, capital connection mainly. And we also have now a yield fund, so credit fund as well, which is just going for the market neutral exposure in the space. And yeah, that's it.
I'm Weso. I'm the CTO and founding member of CAP. CAP is a insured private credit system that utilizes three parties. One is the liquidity provider who mints our CUSD stablecoin. Second is the unsecured credit partner who is borrowing from the system. And then third would be the underwriter who is taking on the collateralization of the loan. And that's what CAP is.
Hi, I'm Anlin. I'm a senior protocol strategist at Gauntlet. I do a program manager role running our ERA strategies and also earn integration with different partners. Gauntlet, we manage over 1.3 billion in TVL across our vaults on lending platforms and ERA. Yeah, super excited to be here.
Thanks all. So credit yield, I kind of set the context. Historically, it's kind of been a static, like hold to maturity game, but really this new stack of strategies and products and infra is really emerging where private credit is tokenized, basically made composable on-chain. And RWAs have grown a lot. There are over 35 billion total RWAs right now. And private credit is more than half of this, at 19 billion. But when we look at active RWA assets in DeFi, it's only 2 billion. So it's still growing a lot, but it's still very early. Thibault, I was wondering if you could kind of like, from the perspective of M11, an institutional allocator, they can access private credit off-chain. They can access through like, Apollo, Blackstone, a lot of different providers. Like what is actually driving the on-chain growth of credit yield?
Yeah, well, credit yield, thanks for precising the tokenized credit part, out of the private credit opportunities. Because if we talk about RWAs, there's a lot there, especially these tokenized money market funds and so on that represent the most of the volume and so on. So I think for us as an allocator, if I talk from an allocation point of view, there's all these fundamentals from the crypto days and just less. I have to say more transparency, better execution and efficiency in the access of these assets, and yeah, you trust less the counterparty, but more what you can audit as a fund specialized in crypto, and then from there we just also go for the more sophisticated strategies, and that's in the title of this panel, I think the composability of it. That's literally why we go for these on-chain exposure. So I do think that for the tokenized, very specific private credit space, their composability thing is very important, and that's where the growth of the volume and the utilization on-chain is definitely defined right now, I think. But if we talk about, for example, the tokenized money market fund, I don't think that the leverage strategy or the composability is right now what makes it that interesting. I think it's a lot more on the operational efficiency, transparency, and maybe for some, other RWAs, like more niche ones or tokenized credit ones, capital access, even if for now this is infinitesimal for most industries. So yeah, there's a lot there, but yeah, distribution first, I think.
Thanks a lot, Thibault. Weso, I remember when I first started reading docs about CAP, I got really deep into the rabbit hole. I think it's fascinating the way that it works. And recently, I was obviously brushing up on it because of this panel. And in one of your latest article, CAP is described as like a covered credit platform. And there's a lot of moving parts, right? There's CUSD, staked CUSD, there's the credit engine, operators, delegators, the financial guarantee market. Like, can you break down a little bit like how it works and why you describe it as this covered credit platform?
Yeah, so I think like one of the problems with stablecoins and what we've seen, I think recently, is a lot of them like blow up because the decision making's on a team. So you give them liquidity, USDC, whatever stablecoin, they mint their stablecoin, and then they go and do some sort of proprietary strategy, whether it's lending it out, running some sort of like high frequency trading, doing a basis play. But then you're trusting this team. You're basically saying, hey, I'm going to give you this. I'm not insured against that. And if you guys blow up, then I'm out of luck, in which we've seen that happen. There's also like a lack of transparency with some of these. And so we wanted to build something a little bit different, something that's going to protect the liquidity side. So it's like, hey, you give USDC, but we can make that insured. So we could still have access to a lot of these strategies, which creates quite large scalability because we're not isolated to one specific strategy, right? So it's not just like we're doing the basis trade. If you wanted to borrow from us and do that, you could. But we're not isolating and doing that specifically. So what we could do is we can offer essentially this liquidity bucket where people can come and take unsecured loans, and then they can go and use it for whatever they want, right? Institutions, we've seen payment financing, inventory financing, people running trading strategies, people using it for LBOs. Like, so there's all of these opportunities now for you to use unsecured lending. We don't really care how you use it, but we have liquidity for it. So now how do we protect the people who are putting the liquidity into the CUSD token? So we just create an over-collateralized market, essentially taking underwriters, people who have some sort of collateral with low risk premium, and then they guarantee the loans of the unsecured credit lines. So now we're mostly just like a matchmaking solution where we're saying, hey, we have this party, wants to borrow $10 million, use it for whatever service or whatever they're trying to do with the funds. We have somebody who has Bitcoin, and they're okay getting 2%, 3% on their Bitcoin. They're underwriting that loan, over-collateralizing that loan. And so now, let's say there's a default, the loan has to get liquidated. We're actually going to liquidate the collateral, pay back the loan, doesn't hurt the USDC depositor. So that's what we're saying when we're saying insured private credit, essentially allowing you to have access to unlimited strategies via the unsecured marketplace without having to take on all the responsibility and risk.
Thanks, Weso. I still think it's a really fascinating way to structure like this kind of platform. Anlin, question for you. So, TradFi call them leveraged strategies. DeFi degens call them looping. It's one of the things that DeFi is great at, just because of the Onchain Rails efficiency. Applying that to tokenized credit is like kind of like a different proposition from like crypto native assets. There's a lot of considerations. Before we go into these in a little bit more details, I would love to ask you like what makes credit such an interesting asset class for those leveraged strategies?
Yeah, I would say in short, it's because credit has yield. If you look at equities or other types of assets, they don't really come with native yield. But private credit, for example, the large asset managers credit ETFs, they are yielding 6-7% right now. And this is due to lending to corporate credit, right? So these sub-IG companies may have high yield bonds or loans that pay a spread 300, 200 bips above the risk-free rate. But they are paying yield, and that's what makes it interesting to tokenize. And then in terms of looping, you can go to lending platforms and often get a better rate than the underlying asset. So this spread, if it's positive, creates an attractive trade for a lot of LPs. And I think a lot of the DeFi native users are probably used to looping permissionless assets, but permission ones like credit are possible on chain as well.
That's great. Weso, CAP is partnering, I think you mentioned some of these use cases where you're partnering with M11, you're partnering with Wisdom Tree, you're partnering with Falcon X, and a few others. And like, I know there's like a real breadth of use cases for those partnerships. What's driving like most of the demand, and where do you feel like this is really coming from?
It's different parts of the system. So like for Wisdom Tree, it's a money market fund. You can deposit it in Minsk CUSD. What that does is it gives any like institutional borrowers that want to complete the KYC flow the ability to borrow a permissioned asset. So if they don't feel comfortable borrowing USDC, we'll have the money market fund you can borrow. Goes, Wisdom Tree, then obviously you can send out money market fund, gets the funds directly into your account, and completes that flow pretty easily for them. So that's more on like the institutional borrow demand side. For like, I'd say the underwriting side, this is like a new category we're sort of pushing out there. Like there are people that do risk and that can identify like, unsecured loan risk. But I don't know that we have a whole lot of people in the DeFi ecosystem that are doing that yet. So we're kind of creating now this like new opportunity where people who have that skill set can come in and do that, right? And so we're working with a lot of different partners that are essentially assessing risk for people maybe who don't have that capability. We have a lot of asset issuers in the space. They're able to get the liquidity, and up until recently, the only yield was essentially like risk-free, right? So like looping and earning token incentives and selling it and getting that. But as that's starting to dry up and it's not there anymore, the yield's going to have to be a little bit more risk on. So we're going to have to see more real yield. And for that, there's going to be risk involved, and there's going to have to be somebody doing the risk assessment. And so I think now we're working with a lot of different partners, either ones that want to come on and manage the assets for the asset issuers, or well, at least help them identify the different risk opportunities, or ones that are going to take on that themselves, right? Maybe they just want to be a risk manager and take on the asset curation part of that as well. So yeah, there's a ton of ways for us to work with a whole bunch of different people.
So many areas. That's actually crazy, yeah. Thibault, so M11 creates the Falcon X structured credit facility on Pareto. It's kind of like the first institutional grade, like tokenized credit product on this platform specifically. Can you walk us a little bit through like what you build and like more broadly, what do you think good infrastructure looks like for bringing like credit yield on chain? And what were like kind of like the design choices that mattered the most here?
Yeah, sure. I think first of all, why we built it was mainly addressing a need for like these institutional to borrow, and we weren't comfortable doing anything unsecured anymore. So we teamed up with Falcon X and their prime brokerage, Onchain, and margin loans, basically covering these type of funding to these institutionals and tokenizing this leg on chain. But the thing is, and the way we approach that is literally from a very TradFi credit perspective, having this partnership and relationship with the Falcon X team. We literally built a credit agreement, took a year long to build and structure everything. We have a credit agreement, the SPV, UCC filed in the US with all the risk mitigants and covenants you can think about, like a CLO type of product. And then the idea was to turn back to the ecosystem, especially on the DeFi side, being the Maven even buy-side originator and so distributor of this deal, and say, okay, who's going to be willing to tokenize that with us? And also who can adapt to this deal we have? Because in a way, we are looking for a tokenization partner, right, before everything. And all the terms in the credit agreement were already there. The event of default, the cascade events, and everything you need to support as an infrastructure needs to be covered. And it's kind of a tailor-made process then we did with the Pareto team. And so I think, first of all, there is a need for access control, obviously. So these KYB, KYC layers and so on, that's something that we built with the Pareto team for this product. And also, there is something a lot of people underestimate is the entire operational support and back-end support that the team is providing. They're emitting the NAV, they are managing the entire netting of the flows. It's a monthly cycle liquidity, so they needed to adapt the smart contract to respect its terms. And myself, or the team as a risk manager, is basically inputting these parameters, just like on any type of other, Morpho smart contract or just smart contract where you have risk parameters, there's nothing like custody and so on, right? It's literally just adapting to the entire credit agreement, tokenizing a price share, and then the Pareto team, I would say the last type of, like the last characteristic we were looking for was on the composability and knowledge of the team to make it the asset that we have right now on Morpho and so on. So we spent a lot of time also on Morpho. We did curation before with the team and so on, and we integrated the asset, being very well aware of where we wanted to go with the assets.
Thanks. That's actually a great leeway into my next question, because what you can do, so if you're an LP into that vault, so you get credit vault tokens, so CV tokens, and then basically what Gauntlet has built through our Era Vault infrastructure and leveraging Morpho markets and Morpho vaults is basically an engine to lever these tokens by supplying them into Morpho markets and borrowing stablecoins against them and basically amplifying the yield. So it's grown into the biggest RWA market on Morpho right now, this Falcon X Credit Vault token. And it's grown from, I think, when it launched, it was about 1 million in TVL, now it's 25 million, which I think is total 51 million size. And it's arguably one of the most, sorry, a little bit of shameless plug here, successful RWA yield strategy on the market, because it's right now sitting at about 13% APY. Anlin, what are the factors that made this work, and what's kind of like missing to like really take it to the next level?
Yeah, I think what makes it work is obviously the partnership that we have here with M11, Falcon X, and Pareto. They are really great at putting in good loans over collateralized ones, where we're very comfortable with the risk and lending to it from the curation side, right? So as all curation teams do, we underwrite risks of what we lend against and supply liquidity to. I think being completely over collateralized has been a good reason why we got in so early and are able to make this leverage loop trade really work. I think generally like the borrow rate has fluctuated between like 4 to 7%, while the underlying APY has ranged from 9 to 15% over the last 8 months or so. So that positive spread is something that the looping strategy can really take advantage of. In terms of how we can make this better, I think one thing RWAs struggle with is there is very limited secondary liquidity. This in part is due to just like liquidity profiles of how RWAs are structured, because you don't want to make the issuer have to process redemptions every day. Like it may not make sense from the fund structure, but also this is a thing that people in DeFi may be used to. So that is something just in general, I feel like RWAs, there's a bit of a duration mismatch that the industry is trying to solve.
Thanks, Anlin. Throwing it back to Thibault, because you just talked about like curation and different types of curations. Like what's different between like curating private credit versus like, for instance, curating a vault on Morpho?
Yeah, there is obviously a massive difference there, I think. So on the role that M11 Credit has here on Pareto is literally to create and underwrite the off-chain partnership and the off-chain deal that we structured, right? And give back this lender report and give back this lender registry to the market. So we kind of, if we speak very like parameters, like we input the duration of the loans and we also input the rates, negotiating everything with Falcon X, and then we give back the lender report with the loan mix and so on. So it's a lot more risk underwriting based, I'd say, on the TradFi credit knowledge. And when it comes to Morpho, we did it by the past, and yeah, there's a very different aspect to it, which is the risk parameters are also, in the smart contracts, you can input a lot there, but there's a lot of permissionless aspects to it, especially in the current version of Morpho. And I think that this is a complete different management and relationship-based management, essentially, because there is no, for example, access control was one of them. Access control is there on Pareto because it's KYB gated access. On Morpho, with the current version, for example, the Gauntlet and Stakehouse team supporting this asset on Morpho, they face borrowers that they know because we know them, because the ones that are minting the principal are KYB'd. That's not true for every asset, right? And then the reallocation knowledge that comes into play, the monitoring of this interest rate model, adaptive curve of Morpho, and the different listing of the different markets based on if they are DeFi assets, if they are RWAs, the type of strategy you want to deliver as almost asset manager, should I say, on the Morpho curation side, is a complete different knowledge and also a complete different ball game than tokenizing a private credit deal and pipeline. You master from A to Z and just focus on that only. So you tokenize an asset and put it on chain. You don't tokenize a vault, even if a vault, ERC4626 Morpho vault is still maybe a token in a class share tomorrow, or maybe you know, anything going this way with a regulation question mark. But the strategy as a creator is completely different.
Yeah, and even setting the, like actually creating the permissionless immutable markets on Morpho for this token is very, very different from crypto native assets. Anlin, can you talk a little bit about like the differences from like a Morpho curation and market creation perspective?
Yeah, I will say for RWAs, when you set up a market, typically the risk parameters are set a bit more conservatively. So things like LTV may be lower, caps may be set lower to start with, things like that. The liquidation penalty or the liquidation bonus for the liquidators will be higher. And this is just because the people who typically are able to liquidate these assets also have to be KYC'd in order to, you know, obtain the RWA. And we still need to incentivize and reward them for using their balance sheet capital and take on that duration risk there. So overall, RWAs, you know, in short, see more conservative risk parameters on chain.
So we've been talking a lot about like markets on ETH mainnet. That wasn't obvious so far. But Weso, Cap recently launched on Mega ETH, and you have bridges with Layer 0. And does that mean there's like demand for credit yield just beyond mainnet? Like how should we think about cross-chain credit overall?
Yeah, I mean, I think like insured yield, where people feel really comfortable with the yield source, is a demand everywhere. So the cross-chain strategy is more of a distribution play than anything else, right? So it's getting it into more different users. There's users maybe that use some side chains way more than they would use Ethereum for a variety of different reasons, making it accessible to them, both on, you know, actually holding the asset side, but also giving them the opportunity to utilize, you know, Morpho for looping. And we obviously have a really close relationship with Gauntlet also to help seed those markets. So that's really the cross-chain opportunity when it comes to the actual like CUSD liquidity token. I do think it's very interesting for the possibility to utilize underwriting assets cross-chain. So maybe assets that aren't native to Ethereum, maybe like native Bitcoin, or other assets that exist maybe on another chain, in where we can still utilize those as the underlying collateral, be able to draw the loans on Ethereum, giving essentially a better opportunity for more liquidity on the collateral side. So we're also sort of like looking into those. So it's a multifaceted approach to a cross-chain when it comes to Cap.
Cool, that's very exciting, this partnership, by the way. And so when we talk about like tokenizing off-chain private credit and bringing it on-chain, like these do not behave like crypto native assets. Like we have infrequent NAV updates. I mean, Anlin, you talked a little bit about those factors. Illiquid secondary markets, liquidation considerations, obviously, it's very widely different. And how can you work around these when you operate like an on-chain leverage strategy? Like how does it play into what changes in the risk framework? Because obviously like it can't be like a real-time feed on some of those assets, and kind of like what happens when the strategy kind of needs to unwind gracefully.
First, I think reporting is quite important. Giving frequent reporting and regular reporting to LPs and making sure like LPs are comfortable with what they're lending to is quite key. In addition to that, I will say, in terms of like for RWA specifically, what we've done is we've had bespoke agreements with certain parties in order to make sure things can unwind if they need to. Again, like with RWAs, a lot of these agreements are just with KYC parties who have sufficient balance sheet and are quite trusted and are able to do so.
Cool. I've got a question for the entire panel this time, which is like, it's still very small in terms of like comparative size, like credit yield on chain. What do you think is kind of like the biggest blocker for like more demand to be driven from institutions at this stage?
Yeah, that's definitely a very good question. You mentioned the gap at the beginning, right? In the report, 35 billion to 2 billion. I think that subscribing to such assets is definitely a fund subscription. So the fund unit that you subscribe to needs to be very well regulated. And the thing is, there's obviously my answer will be focused on the regulation, right? So I think there's a mismatch there in between on-chain asset managers or any type of players looking to distribute with like vault layers. Even nowadays, we're at Vault Summit. And the thing is, there's still a lack of clarity, and you need to be very non-custodial based, breaking down, giving out your entire strategy at first, all the risk parameters, LTV ratios and so on if you're in money markets. And you know, you need to put everything on paper so that you don't fall in a gray area in the regulation side of things. And that should be okay. Otherwise, you need this SIMA license in the Cayman, or you need a CASP nowadays. And I think that's a distribution strategy and so on for the tokenized asset. Otherwise, a tokenized asset himself, there are leaders on the regulation side of things with Circuitize, Spyco, and so on in Europe. I think these guys, they go for the fund unit on-chain, literally, and they don't go round like we did, having an SPV and a credit agreement of 100 pages with a joinder agreement that lenders have to sign in this SPV to participate to the liability, right? So, yeah, the fund unit is tokenizing the fund unit is one thing, tokenizing the asset is something else. I think there's a mismatch here on-chain people going for regulation, off-chain people waiting for regulation. But the pipe, I mean, the bridge pipe should be around the corner, hopefully. At least that's a conviction we want.
I think it's two different things. One's like tokenizing it, right? Like tokenizing maybe something that exists off-chain and you're just like tokenizing that asset or that instrument, right? For us, it's actually like, how do we get institutions to actually borrow? How do we get them to use crypto? Which is, I think, found to be difficult. Some just don't know, right? They don't know how. They don't have maybe very deep crypto teams. But we've started to achieve that. So like for the first time ever, Susquehanna has borrowed from CAP as an unsecured credit line. So we're starting to make headway into that category and get those introductions and show them what the capabilities are and try to break down those barriers a little bit. Some of it has to do with privacy, right? Like traditionally, they're very private, right? A lot of the institutions, and you know, the blockchain is not very private. So I think we're a little behind in that space in order to give the ability for people to maintain their privacy on chain. I also think size, like we just don't have the liquidity. They want to borrow in size, and so you know, we have to kind of grow a little bit and start to build these products up a little bit so that we have enough size for them to make, you know, actually like want to come in and borrow, and they can borrow at size. So I think that's some of the things we've seen. It's like 1, they don't know. 2, they need privacy. 3, they need size.
I think in addition to legal and compliance related things like, you know, AML, sanctions, all that, right now credit on chain, there's a lack of benchmarks and there's a lack of fixed income ratings, for example, right? Like when institutionals think of constructing a fixed income portfolio, they typically look at metrics in the public market, like the public US equities and fixed income markets. There's a lot of diligence and ratings and such, and that might be missing, and that's some of the feedback that we've got when talking to institutions, like how can you really tell what a loan is rated on chain? It just like doesn't really exist right now. So I do think there needs to be a bit more infrastructure built on that end as well. However, I do see like institutionals firms like increasingly wanting to talk about lending platforms like Morpho. So I do think, they are coming and they are interested.
Really good diversity of insights, thank you. Weso, you mentioned, I think, growing like both the borrow side and the liquidity side. I mean, CAP is like a really good example of a multi-sided protocol where you have different kind of like sides that need to scale together. I think you mentioned two of those kind of like, I wouldn't call them bottlenecks, but like area of growth where it's still kind of like limiting. What kind of are your plans to grow those areas?
So what you just mentioned, essentially assessing the risk, is like a major issue because, like I mentioned earlier, we have a lot of asset issuers, but they can't appropriately assess credit risk. So people are coming on, they're saying, hey, I want to borrow. They're well-established institutions, have a lot of history, but people don't know how to assess that risk. It's a little bit of a blocker for us because we need access to that over-collateralization for the loans. And in order to do so, the LPs have to feel comfortable and they have to have some sort of like credit risk ranking. And it's like right now, it's just not a market that there's a lot of participants in, but we have wonderful partners that are helping us and stepping in that space and doing a great job. And then like because it's a three-sided marketplace, it's a little clunky in the beginning because at first we had a lot on the liquidity side. We had a lot that minted CUSD. But then the borrowed demand was there, and it took a lot of redlining when it came to like legal on the agreements between the underwriters and the borrowers. And so by the time they were ready to go, it was like the yield wasn't as interesting because of just market dynamics, and so the liquidity sort of left. And so now we're left with a lot of underwritten already collateral that's ready to underwrite loans, a lot of loan borrow demand, and now it's kind of filling back up that liquidity side. So I'd say for at least a little while until there's a growth in the protocol, there's always going to be that balancing and the rebalancing that needs to happen.
Thank you. So in April last year, Gauntlet launched the first levered RWA strategy with Apollo and Securitize, and now we have this strategy with FalconX, M11 and Pareto, and it's kind of like the pattern looks a little bit similar, right? You have the tokenized credit, you have the awesome Morpho permissionless infrastructure that is powering the vault, and then kind of like the layer on top with the levered strategy. Anlin, like how close are we? Like I know there are lots of considerations which we've talked about for RWAs. Like how close are we to like something that's repeatable for new kinds of like tokenized asset classes to come on chain and be composable for these types of strategy?
I mean, I think it is quite repeatable. One thing that I'm specifically also excited about is fixed rate lending and loans with Morpho V2, and there are other platforms as well. But I do think like if this type of credit product is a rate set on a monthly basis, which does make sense for this prime brokerage type of setup, then maybe we should do fixed rate loans for a 1 month duration as well. So I think there are definitely improvements to the current strategy. Like, there are benefits to variable rate as well, but there's also a lot of benefit to fixed rate lending when the duration is already known. So yeah, very excited for that.
Very excited for Morpho TBA, which I heard is related. Thibault, what's next for M11? What are you planning for the next area of growth? What's the next frontier for you guys? And like driving that institutional demand?
Yeah, sure. I mean, we have this focus on the allocation side, but maybe more on the risk underwriting side and linking the dots with what Weso just said. I think the risk underwriting need is clear. CAP, for example, shifted the risk model, and now we have this supply capital freeing up liquidity coming from the risk-taking industry, probably the best AVS usage so far. And us have a new position where these people in need for yield trust us as a risk underwriter, while there's still the same borrower demand, and the same borrower demand can only access this free liquidity, new liquidity, because these new risk takers trust us before everything to secure the loan. And this type of new improvement and innovation, thanks to DeFi, is definitely where we want to be positioned as the leader when it comes to sophisticated tech-enabled credit, let's say.
Thanks a lot. Thanks a lot, everyone.